ready.
All right. Hello, everyone. Welcome to another phenomenal class by our Caliber Home Loans team. We have Mike and Heidi here who are going to teach us all about loan level pricing adjustments. Take it away, team.
Hello, everyone. Thank you for being here, present and online. This is really stuff that you really don't have to worry much about because, this is actually our job. However, I just want you guys to be aware of new things that are coming into the industry and how this is going to end up affecting all your buyers, that are currently on the look for a home, come spring market. So there's, everybody wants to know what the rate is, so there's a lot of things that come in that come in place to determine what your interest rate it's going to be. And, we end up following, the loan level pricing adjustments that, they are actually imposed by Fannie and Freddie. Okay, those are the two agencies that warranty the majority of the loans that we write. So every time you have a customer that says, I'm doing a conventional loan, my loan is a conventional loan, that means that loan is either backed by either Fannie or Freddie Mac. Either one of them two, it's, insuring that loan for us. FHA, it's a completely different product and that it's being backed by the government. But, there's some features, usually the things that used to go into place into determining your credit score was, your credit score, the loan to value, right? Loan to value, it's how much you're putting down as opposed to that purchase price, the occupancy, and the property type. But most recently, one of the changes that are coming in now is they're adding also a hit for your debt to income ratio that used to not affect. And if you're locking now, it doesn't affect, we'll get into exactly when all these changes are going to go into effect. Go ahead.
Yeah, we gotta get rid of that.
Oh,
I texted,
Amanda. Oh, okay. You know what? Maybe I can do it from here. Oh, shoot. Hold on. I cannot control this mouse. Why? I cannot, this mouse, it's not letting me control it. Oh, so of course, that's why. Sorry, guys.
there it is.
Okay, so here you go. So, so there's fees that go into place and, all these things are what determine those fees. What lenders is this going to apply to? It pretty much applies to every single bank, lender, broker. As long as you're getting a conventional loan, this is going to apply to any conventional loan that we write. So FHA will not be affected by this. It's a completely different agency. So far, no changes coming into them, but and also non-conforming loans are not going to be impacted. Those are more portfolio loans, that banks decide a portfolio and they get looked at a completely different way. Same thing for jumbo and VA are not going to be affected by this. So all conventional loans will be affected by these changes. So
this is gonna take effect starting May 1st. That means usually the lenders will begin to implement the changes in March or April. So you'll start seeing files that go into our pipeline. It's gonna start taking effect somewhere around that time.
yeah, so it probably, if any contracts we start taking in now and they get locked in, let's say, even though you lock in for 60 days, today, and that's going to bring that person into April, they will not be seeing these changes. So, those customers will not be affected. But, I guess May 1st, it's when everybody's definitely implementing it. But, some lenders you'll start seeing, already in effect right before that.
So the effective penalty for having a credit score under 680 is now smaller than it was prior to May 1st. It'll still cost more to have a lower score. For an example, if you have a score of 659 and you're borrowing 75, and you're borrowing 75% of the home value, you'll pay a fee equal to 1.5% on the loan. Before that, you were paying 2.75. So people with lower credit scores are getting somewhat of a little bit of a break. So you'll save somewhere in the difference around, like it says in the slide, around $3,750.
Yeah.
They're also implementing 2 new FICO buckets. It's 760 and 780, where it used to be 740. It didn't matter if your FICO score was 800, you were getting the same pricing as a 740. Somebody who had 740 FICO.
Yeah, so another thing that changed a bit there, it's, some of the customers now with the higher scores are actually going to pay a little bit more. We have a chart that it's perfectly, that's going to, oh, hold on, I'm going the other way around. Why is this going with this? Okay, so, so for example, there are new credit score bands, okay, at 760 and 780. That does not used to exist before. It used to be 740 and above, and they added a new bucket for 760 and 780 now. There is more differentiation in a high balance versus non-balance, a high balance arm. And several changes are also made in 2 to 4 units. So that also got affected. So this is the chart. Okay, this is the changes based on credit score and loan to value. Okay, so you guys can see the way this chart does it perfectly. It's because the green means it got better, the red means it got worse, and then the oranges and the yellows are kind of like in between. So, obviously the greener it is, that's where, people are going to fit the most. So for example, in the past, usually when someone came in with, let's say, a 640 credit score or even a 620 credit score, right? We would give them the options. So with the 620 credit score, and let's say you're putting 3% down, right? We will give them the options of FHA. FHA always seems so much better because the rate was a lot lower because they used to get penalized for the lower scores. But in this case, on the like the 739 bucket, you can see that at putting 3% down, it actually, the hit, it's getting a lot less now. So they're getting a big benefit to that, right? As opposed to if you look at the 780 bracket, this is a touch screen. The 780 bracket, putting 3% down, they're still saving, but they're not saving as much. The lower credit scores are gonna look a lot prettier. So I feel like where this is helping is, in the last couple of years, customers with the lower down payments and the lower credit scores, FHA was a better option for them. But when they were going to put offers, people were like, oh, FHA, nobody liked doing FHA, right? But, in order to go conventional, it was just going to be that much more expensive for the customer that it didn't make sense for the customer to choose that option. So now Fannie and Freddie are opening up more options for this customer. So now customers are going to have, with the lower scores, are going to have better options than just going with the FHA. Fannie and Freddie are choosing to be, open about, the rates being more competitive, nowadays than they were in the last couple of years. Another change, I'm going to show you another chart, right? Because also, there's that other chart, it was the first one in this one, but it was showing where the greens and the reds, but the one at the bottom, it's what I find interesting too, because this one, hold on, how do I move that so I can see? No,
I know. go off the-
Oh, the screen, that's right, okay. So now there's a hit for, so you understand when a customer came and we used to say, everybody wants to know what's my rate, right? We don't know till we know your full situation. This chart here at the bottom, it shows you, like if you're getting an adjustable mortgage, depending on the loan to value range, right? What kind of hits are gonna get into your rate, right? So a condo, okay, that's what we always say, like a condo, if the customer puts, 25% down, it's a lot better the rate, because look at the hit for a condo. If you're at 70 loan to value, it's only an 8, but if you're at 80% loan to value, you're paying 3/4. It's that much more expensive for for the condo when you get into the higher LTVs. Same thing, look at investment properties, right? So investment properties, look how interesting this is. Now at 80%, at 80.01% or higher, it's a hit of 4.125 to the rate. The rate is going to be that much higher into getting hit into the pricing. Same thing for second home. So investment properties and second home are really getting a big beat, into rates coming May 1st. Same thing for 2 to 4 units, right? So look, 2 to 4 units with the higher LTV. So if you have somebody putting, even just 5% down, the hit it's 0.625. However, if the loan to value, it's 60%, there's no hit for the 2 to 4 units, right? So there's a lot of things that are changing, and then the biggest one for me, it's the debt to income ratio now, right? So that never was a factor. Debt to income ratio, if you're new and you don't know what that means, is when the banks get you approved, we count your proposed mortgage payment with taxes and insurance, plus any other debt that appears on your credit report. We add all of those up, and we divide that into your monthly gross income. And whatever percentage comes out of that, it's what your debt to income ratio is, right? So if, let's say, 40% of your income or less went into paying mortgage, taxes, and insurance and the rest of your debt, and you were borrowing, 60%, nothing happens to your rate. There's no hit. However, if you have customers at, let's say, 45 debt to income ratio, or even, 47, right? You see there's now a hit depending on your loan to value, up to 3/8. So, there's big changes. I don't expect, this is a lot boring stuff that us mortgage people got to worry about, right? The main thing is, I guess, the great news is, or FA, the borrowers with the lower credit scores and the lower down payments are now going to have a lot more options. So this tells me it's just more opportunity for your customers, right? When we were saying, well, he's FHA, that's the only way he can get a loan. Well, now they might, conventional just got that much more competitive. So, now they're going to have, we might be able to flip them into a conventional product once May 1st, all these changes come in, and still be able to compete on the market. So I know I threw a lot of stuff at you guys. Does anybody have questions?
So I guess the reason why they're changing everything else is trying to like the long run balance out, making more opportunities for people who are credit scores.
Yeah. Yeah. Yeah.
So it creates more opportunities to switch like listers, because they have more people to buy.
100%. Yeah. Yeah.
I mean, conventional, sometimes the mortgage insurance, if you had a 630 and stuff along those lines, was $400 or $500. So now they're giving different hits and different, to make it affordable now. So we can get more people to that conventional side.
Yeah.
So I guess kind of like how there's issues with like the banks and maybe this in the past that created like a bubble. I think that's something like that. It's like people are going to be foreclosing a lot more in the future.
I don't
Well,
think so.
I really don't think so. So like a good thing, so this is the way I see it. In order for foreclosures to happen, people got to stop paying their mortgage. Right? Usually people stop paying their mortgage because they don't have means to pay it, right? Because, listen, in order to live somewhere, you're going to have to pay every month, right? So might as well pay your home. So someone might they only stop paying because it's either, medical purposes, medical reasons, or they lost their jobs. The one big thing that just came out last week, it's unemployment rate. Unemployment's down. That means people are working. No one is, people, less people are filing unemployment. So it's kind of tough for you to see foreclosures when if people are paying their mortgage, nobody's foreclosing, right?
And also back then, they were giving out mortgages.
It was completely different.
Yeah.
Right now, all these mortgages, before you could get 100% financing, we didn't have to check your income. So you could have been a cleaning lady and, we would say you make $14,000 a year, right? To get you into that house, we didn't have to prove it. Now, those mortgages that do exist where we don't have to prove income, they require for you to put at least 25% down payment, so it's a lot less risk. Someone that's putting 25% into an investment, it's going to be less likely to default on it because you have a lot of money in the game. If you didn't put any money out of your pocket, right, it's a lot easier to say, I'm going to walk away from this, right? Because you have nothing to lose. You put nothing in it. And that's what was happening before. No one was putting anything in. It was really right now, those mortgages, no income verification, really don't exist. The only time they exist is if you have a big chunk of money to put down. So it's going to be tough. Unemployment, it's low. That means people are working and they're making money. We're doing mortgage pre-approvals, we can only get those if we can verify income. So I don't see that happening. I feel like it's going to be more, I guess, if people start losing their jobs, then that might happen because then they'll be struggling. So they'll have to make a decision to either sell their house before they foreclose, right? Or, I guess, because the ideal thing is for someone to not foreclose into a home, of their home. So, but I don't see that happening, at least not anytime soon, not in the near future, based on all the data that's available to us. It's just not, don't see it. Any questions in regards to, this?
Yeah, the top one, so what percentage, that's how much you bring down?
Yeah, so the percentages on the top, it's your loan to value. Loan to value is what the percentage you're borrowing against that purchase price, right? So 97% means we're lending you 97%, you're putting 3% down. 95, same thing. So that's, the percentage of what you're borrowing. So it's just going to really create more opportunities, more buyers. There's still going to be qualified buyers, right? Because you have to have a job and you've got to have income in order to get approved for all these mortgages. So, I think this is actually positive. It's going to create more buying powers, so like when people say like the market's going to crash, I'm like, there's still no inventory. At least in this area, right? We're going to create more opportunity. There's still not enough inventory. I don't see it in the near future. So, I think, just got to do the basic things and, so we can get people into homes. Any online questions?
I think we're all good. No questions in the chat. But as always, if you guys have any questions, reach out to Heidi and Mike, and they're going to be able to take care of anything you need. They're phenomenal partners of ours, and I can't express how great they are.
Okay, all right. Thank you, Amanda. This is it for our class. Thank you for attending.
I do have one question.
Okay.
I guess